Good afternoon, everyone. My name is Salvatore Lascala. I'm from Guidehouse, or good afternoon, or good morning, or good evening, depending on where you are situated. Thank you so much for joining us today. We have quite an action and information-filled hour ready for you. We're going to be talking about FinCEN's final rule for beneficial ownership, information reporting requirements, and the Corporate Transparency Act, and kind of all the things around it. It's been coming for a while, and this is a perfect time to get a little bit of a summary. If we could advance, we have a very nice panel for you today. I'm going to ask our friends from Pillsbury to introduce themselves first. Deborah and Andrew,
Sure.
Please say hello.
Yeah, thanks, Sal. So first of all, everyone who's attending, thank you so much. We so appreciate your participating, listening to us today. And certainly if you've got questions, we'll be happy to answer them as we go to the best of our abilities. I'm Deb Thorne-Peden. I'm a partner with Pillsbury Winthrop. I'm co-chair of our global payments team, as well as a couple other teams. By way of background, I spent 10 years in-house at a bank where I was the BSA attorney and have handled anti-money laundering and BSA and OFAC matters for a number of decades now. So that's my background. And once again, we're really pleased to be with you today. Thank you.
And I'm Andy Weiner. I'm a senior real estate partner at Pillsbury. And from the moment I heard of the CTA, I took it on and have been tracking it assiduously ever since, because I find it a fascinating exercise, and I think it will be a lot of time and effort on all our parts to get right.
Thank you. And Samantha and Anuka?
Hi, I'm Samantha Welch. I'm a partner at Guidehouse. I have over 20 years of experience in financial services, including working on implementing the CDD rule, which will be impacted by this new reporting rule. Thank you.
Hi, my name is Anuka Kakaseral. I'm a director at Guidehouse in our Global Investigations and Compliance Group, and I have 17 years in BSA AML compliance, and looking forward to speaking with you more on this topic.
Thank you. And my name again is Salvatore Lascala. I am the GIC's global practice leader for financial crimes, and I'm an attorney and an accountant and a former special agent, and have pulled all that together and had about a 30-year career now in financial crimes consulting. So very pleased to be chatting with you today. And you all should know that this panel was, before we started, very excitedly talking about all the different things about this, about this beneficial owner rule and the CTA that I think we're going to get a great presentation. Just a quick look at our by the numbers slide. It's been almost 6 years since FATF issued this year. I think that is a fair amount of time, and that introduction was, nicely measured, right? It's something that has been coming for over, as you can see, 2 decades to address the challenge of money laundering, which can be from $800 billion to $200 trillion, around $300 billion in the U.S. Alone. And, there will be changes and there will be challenges, and we'll talk about some of that today. Some of it will be the cost of compliance. Others will be around governance, oversight, and accountability. But we will walk through it. And how we will walk through it is, if you look at our table of contents, we're going to talk about the Anti-Money Laundering Act, the beneficial owner requirements, FinCEN's beneficial owner information requirements final rule, case studies, steps and challenges towards global implementation, timing and next steps, and we'll conclude and hopefully have some time for good questions. The Anti-Money Laundering Act of 2020, this is something that we are going to ask Anuka to begin to present with us. Anuka?
Sure. Thank you, Sal. So before we get to the good stuff, I wanted to give all of you a quick refresher on the background of this, because it has now been almost 2 years since the Anti-Money Laundering Act of 2020, or AMLA, was enacted as part of the National Defense Authorization Act. And as you can see here, the AMLA is broken out into these 5 titles, and it's meant to clarify and streamline certain AML and BSA obligations. And it also establishes a new regulatory requirements to strengthen, modernize, and improve compliance programs. And they can do this in a few different ways. So they are trying to improve agency coordination and information sharing. They are adapting laws to new and emerging threats. They are promoting technological innovation, reinforcing the nature of risk-based programs, establishing uniform beneficial ownership and reporting requirements, and establishing a secure non-public database at FinCEN to house that beneficial ownership information. So those last two are, of course, going to be the focus of this webcast. Now, another point before I let our colleagues move towards their topics is certain provisions of the AMLA became effective in January of 2021. Other provisions became effective at later dates. And additionally, the AMLA commissioned multiple regulatory studies and reports, and these may also result in the issuance of guidance, new requirements, or even actually amending existing requirements. So with that, I will hand it over to Deb, who will give you an overview on the beneficial ownership requirements that are detailed in Title 64, also known as the Corporate Transparency Act. Thank you.
Terrific. Thanks, Anuka. So as I get into this, actually, I wanted to focus on something that was on one of our first slides, which FinCEN itself has estimated that for the first year's compliance, that 32 million companies in the U.S. will be impacted. And the definition of impacted companies is broad. It can include shell companies. It can include certain types of trusts. It can include all sorts of different financial vehicles. And although a little bit later in this, we'll go through a lot of the top exemptions, there are 23 of them. This is, I think, one of the more extensive record keeping and reporting obligation I can think of in the history of the U.S., at least, putting aside perhaps taxes. And one of the things that's really important about this is for a lot of the companies that will be impacted, they may not have ever been subject to the Bank Secrecy Act before, other than perhaps FBAR filings if they've got foreign accounts. So for a lot of the companies and entities that are going to have to be reporting, this is new, and many of them may not even know who FinCEN is or that FinCEN is part of the Department of the Treasury. So I do think it's going to be an extraordinary amount of work in terms of companies, particularly that are newer to the industry or to Bank Secrecy Act requirements. And it's certainly going to be an interesting time, and there are a lot of questions left to be asked on it. And as noted here as well, FinCEN also estimates that for the first year's reporting requirements alone, it will be $23 billion, if I recall, with an estimated $6 billion thereabouts every year thereafter as new companies get registered. So just in terms of the impact, it is pretty extraordinary. And I'm sorry, with that, we can go back to my other slide. Okay, so FinCEN had obviously put out the final rule just a bit ago. And in the final rule, they spend a lot of time talking about the number of companies that will be potentially impacted. Certainly a lot of the reasons for putting the law in place to protect against, to protect for national security purposes. They basically want to have a clear disclosure requirements for companies that are under federal law to disclose their beneficial owners, which is quite a broad definition, which we will get into. For those of you who do CDD today, which is applicable to banks, the maximum number of beneficial owners under that structure is 4, and under this structure it is many, many more, as well as top officers of the entities. And certain information on the people who's actually doing the report or the recordation of new entities in the first place. They are estimating going forward, or based upon current statistics, that there's about 2 million entities formed each year in the U.S. alone that will be impacted by this. Some of this has come about because, as mentioned earlier, FATF had noted that the U.S. was not quite as forward on some of these requirements as other countries have been in terms of requiring beneficial ownership. And FinCEN certainly indicates in the final reg that they think that a significant amount of money laundering and possibly some terrorist financing runs through shell corporations and certainly some of the companies that will be required to report. I'm certainly not suggesting in any way all of them, but that's the background on it. And I think with that, we can go to the next slide, please. So it is pretty extraordinary because what FinCEN's having to set up is a massive registration system, and all the information to be reported will be submitted to FinCEN, and FinCEN will maintain it on the Beneficial Ownership Secure System, also known as BOSS, which FinCEN is building out as we speak, as it were. Reporting entities have to provide not only information on their beneficial owners, they're also going to have to provide information on the company applicant. And as part of that, they require very specific information on the names of the entity or individuals, street addresses, date of birth for individuals, and also a copy of the ID documentation that's been used to authenticate someone's identity is going to be included. And I note that the only IDs that are allowed are IDs that have not expired, and basically it's passports and driver's licenses for the most part. If you've got a foreign entity or foreign individual, I think that you can possibly use an unexpired passport from them as well. But it is an interesting requirement and certainly a little bit different in terms of one's going to have to be providing those images up to FinCEN as part of the BOSS registration. In terms of who's going to get access to this information, and again, they think first year alone, it's 32 million companies that will be reporting. It's going to be law enforcement, of course, because a lot of the purpose of this is to protect against money laundering and terrorist financing. Obviously, other sorts of intelligence agencies may request access to the FinCEN registry. It's going to be very limited. And there is an option for U.S. banks to be able to get limited access to the registration. I believe how that is going to be constructed is that the banks would need to ask their customer if they can have access to the FinCEN registry. But I also want to note, and this is really important, that the law itself significantly limits the usage of that information that comes from the FinCEN registration. And so one thing that we'll talk about more is FinCEN is going to be coming out with another rule talking about banks' current requirements under the CDD rule in contrast to this rule. But certainly something I think a lot of banks are going to want to have is the ability to continue to, on their own, require beneficial ownership information as they do today and be able to use it in their own ways today for their own KYC and other purposes. I suspect that not all banks will want to do that, but I think probably a lot of banks will want to do that rather than having to go through this process for getting information from FinCEN, especially since the banks are going to continue to have obligations to understand their customers just as usual, as well as understand beneficial owners for their customers. So that's my personal guess at this point. But I do know that FinCEN is going to be coming out with another rule on that, presumably in the next few months. Next slide, please. Okay, so one thing that FinCEN did do in the final rule, which I think is very helpful and is tremendously important to those of you listening, as well as the other companies that may be subject to this rule, is there are 23 different exemptions that are available under the final rule. We've got some noted here at the back appendix. We have all 23 noted. Some of them are pretty easy and pretty obvious, such as banks that have FDIC insurance basically are exempt. Publicly traded companies in the U.S. are basically exempt. A big one for a lot of companies is going to be there's an exemption for large companies, which are basically defined as a company with a U.S. physical presence with 20 full-time employees in the U.S. offices with revenues of over $5 million gross based upon the prior year's tax filings. And any sort of foreign sales can't be added to come up to that $5 million total. But that's where a lot of the larger companies in the U.S. won't be subject to this. And I think the rationale there is that for those companies, they probably have more oversight anyway. But for a lot of companies, I think trying to figure out if they're exempt, I think looking at large company exemption would be the first place to look to see if they fall within an exemption. Similarly, in the U.S., Money services, money transmitting businesses are going to be exempt. But something that is, I think, of some significance is one of the other exemptions applies to subsidiaries. But that exemption that applies to subsidiaries of exempt entities does not run to MSBs and a couple of other types. So if you're looking at the sub exception as one, which is one of these 23, you do need to work through whether or not your entity or your exempt entity falls within the ones that are covered by that sub, because there are certain exempt entities where that subsidiary exemption is not going to apply.
But there's also, on the exemption,
ahead,
can I just raise something? On the exemption, it has two aspects. One is, if you're an exempt entity, you're not a reporting company and don't have to reply. The other is, if you are an owner of a reporting company and you're exempt, you stop at the exempt company, and that exempt company doesn't have to disclose its upper tier people. So it's really, in both those capacities, exemption becomes important.
And as I noted, we've got all 23 listed. Certain types of U.S. insurance companies, whether federally registered or state registered, are exempt. There's certain exemptions for truly dormant companies. For charities, charities that are under 501c3 are qualified as exempt, but other charities are not necessarily, unless they fit under a different exemption here. So it is, as you can see, it's going to be something where people are going to have to truly parse through initially whether they fall within any of the exemptions, and then only after they get through that will they then determine what they've got to file and on whom. So that, I think that's sort of probably enough on that slide. Maybe the next slide.
Okay, this one's on me. We're going to talk about penalties for non-compliance. Before understanding penalties, there are a couple of things to realize about the way that the regulations implement the CTA. The CTA imposes both civil and criminal penalties for failures to comply, and also for unauthorized release of data from the registry. They do seriously need to keep the registry confidential. The burden of compliance is on the reporting company. They're tasked with reporting their beneficial owners. However, the people who administer that on behalf of reporting companies and the reporting companies can both be liable, and we'll go through how. Because the definitions of ownership and control, we'll get to in a few minutes, are not clear and are in fact extremely broad and in many respects circular and vague, nobody who is tasked with reporting a complex structure is going to know for sure they're doing it right. And that adds an element of risk to this model, depending on how FinCEN chooses to enforce. The approach of the regs is like that of the Bishop of Béziers in the Albigensian campaign of the 13th century. Kill them all, God will know his own. It's basically report almost everybody and we'll figure out who we want to look at. The problem is that FinCEN understands that the ownership and control of complex structures can be diffuse, hidden, and indirect. And the people they're trying to reach are exactly those people who are trying to hide behind diffusion and indirect ownership, and therefore they want all the names, and therefore the definitions put on somebody the burden of reporting everybody who has indirect and direct influence, and we'll go into that. This sets up a potential conflict between the reporting company and those who have to report information to the reporting company, because they're not necessarily the same. It's between sponsors and investors, it's between general counsel and the counsel of their investors. And it's going to be interesting to see how this plays out. Second, the reporting company doesn't necessarily have this information. And as you'll hear, not only do you have to file an initial report, you have to very quickly, after facts change or after errors are surfaced, tell FinCEN about them. But there's no mechanism to have that flow of information, almost like neurons sending electric signals to each other. That's not how complex ownership structures work. And therefore, this has all got to be worked out. And in many cases, in a situation where the documents don't require anybody to report. The third thing is, while FinCEN, the registry may be secure, and we can all think about that, you have to collect a lot of data in order to report. And I haven't seen anything which makes that data secure in the hands of the reporting company or not subject to subpoena, which is another interesting thing. And the fourth thing, before you get into any of this, is trying to figure out, does this give FinCEN a right to just go in and do fishing expeditions to everyone to try and figure out their ownership and control structure? Don't know. So going back to that, what is the matrix for making someone or some company liable? Well, for reporting violations, willfully providing false or fraudulent beneficial ownership information is actionable. Willfully failing to provide complete or updated beneficial ownership information is actionable. And so therefore, both the companies and people who report to the companies could be in the sites of FinCEN. There's a civil penalty of not more than $500 per day, and criminal penalties of not more than $10,000 or 2 years of imprisonment. There's a whole nother set of penalties, which I really won't go into, for unauthorized disclosure or use. That would typically be by lenders in some cases, but mostly if people at FinCEN or people in foreign or state governments that have access to the database do that. So what does FinCEN do to try and shield people from being subject to fine or imprisonment for reports that inadvertently get wrong? Well, the regulations say that, or at least the comments on the regulations say that it's based on all facts and circumstances, and inadvertent mistakes in good faith after diligent inquiry are not willful. But that still puts a heavy burden on the people who are reporting. But they also says individuals are liable if they cause the failure, or whether or not they cause the failure, if they're a senior officer. Well, senior officer is anyone with the authority of a president, CFO, general counsel, CEO, chief operating officer, and then they do the standard FinCEN basket move, or any other officer, regardless of official title, who performs a similar function. So there are an awful lot of people, including people who have no official responsibility for filing reports, who could be shot at by FinCEN for a filing which is incorrect. We'll see how this plays out.
And Andrew, we've got a question here, which I think is a great question, which is, how are law firms going to handle the applicant requirement? Will lawyers be providing their passports to the reporting companies they help form or obtaining a FinCEN ID? And then
that's when you're a control person. The answer is yes. My paralegal, who regularly works with CT Corporation System and filing entities, is going to show up a lot, and I'm probably going to show up a lot. Now, in point of fact, control parties don't have very much responsibility under the CTA, so it's relatively benign to be listed if that's all you are. You haven't done anything wrong; you've just filed. And it's another way of making it more palatable. There's something called an identifier, which FinCEN will give people who submit to FinCEN all their personal information. So when a company files, they don't say Weiner, he filed that company for bad guy 1. It'll say FinCEN identifier A2405, so that only FinCEN will know who that actually means. So it's some way of mitigating the interim effect of being labeled for doing nothing more than acting as a ministerial filer of a company. It's still pretty daunting. I don't really want to start telling my paralegals they're going to be on a FinCEN file, and I don't want to be one myself. There's no way around that. And the whole way that this is going to change the practice of law, and the way lawyers deal with general counsel and general counsel deal with their client, is something people haven't even started thinking about. I have like 3 or 4 emails into my current general counsel, which have not been answered, saying, what are we doing? And I don't know how much we've been thinking about it, but people have got to start thinking about that.
Yeah. I suspect some law firms may choose to not do incorporations, but we will see. I don't think that's going to be an option for many of them. For the same, Andrew, for the same individual to ask the other question, they also asked if obtaining a FinCEN ID, so if you've obtained a FinCEN ID, how will one manage the requirement to update FinCEN regarding changes in their address, name, or expiration of their ID documents for the rest of their natural life?
Well, there are limitations on the requirement for someone who does nothing more than file
Right.
to update information. But the whole idea that within 30 days after a change, someone who, for example, is a general counsel, and by the way, FinCEN in the reg says we were asked to only require material changes to be reported, and we turned it down. Every change should be reported. So presumably a general counsel who moves residences will have to file, and the company will then have to revise the filing. And the amount of information is kind of, that's why, the metaphor of a cell with synapses flashing out data all the time, that sort of comes to mind when I think about what FinCEN's actually asking reporting people to do. And I don't have any idea how and particularly if you've got tiered entities where it's not a parent-subsidiary relationship, I don't know in practice how any of that's ever going to get done in the time frame FinCEN thinks it should be done, or even get done at all.
Maybe go to the next slide now. Sam, I think that one's yours.
Yep. Samantha?
Yeah, and thanks. One of the things just on that last point too, right, even though it's limited as to the applicant and what they need to do go forward, right, if this is your business, you will be in this perpetual, right, updating mode, just because that is the nature of what you're doing. So it is a real challenge. I agree with everybody. So going on to the next slide, this rule, the reporting rule, which is the beneficial ownership reporting, is the first in 3 that are going to implement the CTA. The second one, and Deb touched on this before, is the access rule, which will define who can access the database, what safeguard rules, and for what reason. So it'll be critical. They are coming in sequence for a reason, right? The reporting rule will tell you what's in the database. The second, the access rule, will be who can access that database for what reason, and what safeguards need to be in place. And then the third will be a rescinding of the CDD rule and a reissuance. And that one, I think, is the one that those in the financial industry are keen to see what the text of that looks like, because today there are very specific requirements under the CDD rule and exemptions under the CDD rule that don't exactly match to the reporting rule. And this goes to some of what Andrew was saying just a minute ago, right, where those, and we can go on to the next slide.
Before you do that, one thing about the allowing other governmental agencies to access it, everyone talks about the CTA in terms of anti-money laundering or anti-terrorism. This is also a tax statute. Any taxing authority can go into the data, can submit and get access to the database. And if you think about, was it 85 billion going to the IRS to hire new people, and you combine it with the new tool you have in this database, you begin to see the way in which all of your personal affairs have now become open in a way they never were to the revenuers.
One thing I do want to note is I do believe the final rule does indicate that FinCEN's BOSS system and the registration will not be available to FOIA requests. Now, that doesn't necessarily extend to certain subpoena requests, I suspect, except for limited circumstances where one falls within the right to request information. I suspect FinCEN will otherwise view this information probably more aligned with SAR information, perhaps at that level of privacy, but obviously something that's a bit of an unknown right now. Sam, back to you.
Similarly on that, right, there is a lawsuit that came out on Tuesday where one of the parts of that lawsuit talks about FinCEN giving this information over under national treaty. So some of the national treaties that the United States signed on to, for example, the prevention of corruption, right, there is no requirement, according to that lawsuit, there's no requirement there for FinCEN to really evaluate the request coming in before handing over such information. So it'll be interesting to see how some of that plays out. So just going on to the next slide, and this is really a lot of the meat of the reporting rule. So what is a reporting company? I think Deb went into a bit about what those exempted companies are. These are the reporting companies, those that will have to comply are foreign or domestic, created or registered in the US to do business. The information for the reporting company will be legal name, trade or DBA names, current street address or principal place of business in the US, jurisdiction of formation, and a tax ID number. That's all pretty much standard. It looks very similar to a lot of the CDD that financial institutions currently collect on customers. We'll go into that in a few slides. Beneficial owner, this is really where, and I know, Andrew, you have some points on this too. I think part of the challenges with the reporting rule are the way that the beneficial owners are defined. So if a controller exercises substantial control, then they are considered a beneficial owner. There's no limit to how many people need to be identified under this prong. And that substantial control, how the rule reads, it's really based on what they can do. So it's not necessarily a legal analysis about how they are formed or what that person is, but it's really the influence they have, what decision-making capacity they have for the legal entity. It's really can change, and the dynamics of a company will change who has to be reported. And again, then you trigger those 30 calendar days to report. The company applicant.
But before you go into that, the good news is beneficial owners do not have to put their social security number or tax identification number for their entity in. That's exempt for now. So it's only, you don't have any really sensitive, well, an address is sensitive, but at least social security numbers don't go in the system. Sorry.
The other piece on the beneficial ownership, the other prong on that would be the 25% beneficial ownership. This is also the way the FinCEN rule works is that it is direct or indirect beneficial ownership. And it's looking at, it specifically says that you need to look at financing type of arrangements. So call, put, straddle, that type of thing, right? If that confers beneficial ownership upon the individuals, then that individual needs to be reported.
And Sam, what happens if you've got somebody who's a minor today but turns 18?
You report the day they turn 18 or within 30 days.
Within 30 days, right?
Within 30 days. So there's really, I think one of the big challenges here is how dynamic and how vague, as I think somebody said before, how vague these definitions are. The company applicant, we talked about that a minute ago in response to one of the questions that came in. It's somebody who directly files the initial report or is responsible for directing or controlling the filing of the initial report if more than one individual is involved. For those companies formed before January 1st, 2024, that company applicant will not need to be reported. It's anything coming after Jan 1, 2024. And then again, it's part of the 30-day filing. And then we talked about exempt entities before. There are 23 exempt entities. Some of them depend on if you're in the US or if you're not. Some of them depend on how much in assets you have or employees, right? So if you're hovering around that 20 mark, you may end up having to report. And then if you actually do not, you meet the exemption requirement, then you also have to report that you are no longer reporting. So it's very challenging and complicated. It'll be interesting to see how what guidance comes out from FinCEN, which they do talk about throughout the preamble, that they're aware, that this is complicated and what guidance will come out.
And the statutory phrase about when you have to report changes is when you know or have reason to know. So once again, you're in subjectivity and you're trying to prove a negative. Maybe FinCEN has to prove a positive. You had reason to know, but you're never going to be completely out of the woods if something isn't reported.
Yeah, that is certainly a tough one, because anything that has some expiry date, right, it means that you kind of knew or should have known, right? Because if you know that if it's good now, you know it expires in 3 years, you know that you've got some kind of deadline or some kind of activity in 3 years that has to be, taken into account. Very challenging. They must have to be dynamic systems, I think, in order to be managed, more comprehensively.
The other thing with that too is, that's a great point. Who adjudicates, right? If you report 5 out of 6 people that can influence certain decisions at the organization, right? If you somehow left off that 6th person, right? Who decides that you did it intentionally or not intentionally? And when you have reason to know that there's an error, then you have to refile. So those job descriptions need to be updated, things like that. It's, there's a lot of downstream impacts on this.
Well, the thing that is not mentioned here in any of the regs at all is what happens if there's a disagreement within the group as to what needs to be reported. And particularly, a lot of existing joint venture documents have conflict provisions. Like, you're not allowed to disclose certain things, and suddenly you have a statute which would require you to do that, and you might be disclosing it in a situation where the other party disagrees about the necessity to do so, and is vigorously opposing it or just refuses to give you the information. And no existing joint venture documents I know of cover this because they had no reason to cover this.
Andrew, I suspect some of that is FinCEN will view that akin to your issues with with FBAR reports, right? I mean, it's a reporting requirement that's affirmatively required with civil and criminal penalties if it's not adhered to.
Well, that's right. But right. And you're absolutely right. And there are a lot of people overseas who they can't reach.
Yep. And
the reporting company is in the dock because of it, and it becomes very uncomfortable for everybody.
Sam, do you want to go on to the next slide?
Yeah, I think we were already touching on the next slide. The reason to know is highlighted here. That's critical, as Sal was saying before. The 30 days here is calendar days. That doesn't give a lot of time. It aligns to the suspicious activity reporting rules for that 30 days. I think we can move on to actually the next slide.
This one's mine, I guess. But again, because the statute says a reporting company must have to make a filing in order to exist, entities such as general partnerships, sole proprietorships, common law trusts are not reporting entities and do not exist as reporting companies for purposes of the Act. They do exist as beneficial owners, or at least companies through which beneficial owners have an interest. Trusts are really, really important. Because the statute is written the way it's written, FinCEN is stuck with saying that business trusts, which have to file with the Secretary of State in order to exist, are subject to this, but common law trusts generally are not. And that doesn't mean you don't have to, if a common law trust owns an interest, you don't have to report the trustee, but you don't generally have to report the beneficial owners of the common law trust. FinCEN is squirming under this. And in point of fact, in the regulations, there's a purple prose paragraph where they're effectively begging the community to come in with comments to force them to expand the definition of trust, which can be subject to the Corporate Transparency Act. There are categories of individuals who are not required to file. We've got some of these here. Creditors acting in the capacity of a creditor are not reporting companies, but all of us know that there are equity-flavored debt instruments. There are situations such as bankruptcy where creditors could take over a large role in the operation of their debtors. There are loan agreements that have covenants and consent requirements so broad that they may skate into equity. So just because you're a creditor doesn't mean that you're not someone who has to be reported. Minors, again, until you reach the age of maturity when you do have to be reported, you don't have to, but then the parent or guardian have to be reported. Intermediates and agents don't have to be reported, but the real parties in interest have to be reported. Employees acting solely in the capacity of employee, other than senior officers, don't have to be identified. And people who are named, have an inchoate right of inheritance don't have to be named. At the minute that the property interest is vested in them, the 30-day clock to be disclosed starts. Now, then we go into, the differences between the CDD and.
So do you want the next slide, Andrew?
I'm on the next.
There we go. Yeah.
One. But Samantha can start.
Sure. So the definition of beneficial owner, and this is actually tying into, Andrew, what you were saying on trust, right? That is one of the things that is significantly different, where you have substantial control by nature of being a grantor, or if you can revoke the trust, right? Those are different than the trustees, which are required under the CDD rule. So some really significant differences there. And again, there's no numerical limit when you're looking at the CTA or the reporting rule implementing part of the CTA. The CDD rule has up to 5. And then the responsible party, this goes back to what Deb was saying, the CDD rule is on financial institutions. They have a long-standing relationship with FinCEN in order to, for reporting, for Bank Secrecy Act oversight. In this case, you have all of these reporting companies that probably have not touched FinCEN and might not even know it exists. So it'll be interesting to see how FinCEN deals with that to get the communication out and get those reporting companies aligned to what they are required to do. The population coverage, so for the CDD rule, clearly that's customers that obviously are defined as customers under the BSA. Here it's entities, foreign or domestic, registered in a U.S. jurisdiction or established in a U.S. jurisdiction, that's state or tribal. And then the point of collection, it's at account opening. This somewhat aligns account opening versus entity formation, or when you register to do business in the United States. And then information availability. This is somewhat still a question that will be resolved in the access rule. But for the CDD rule, covered financial institutions are required to comply. And then for the BOI reporting rule, government, law enforcement, for national security and national intelligence purposes, financial institutions upon request should be able to access the database. And then updates. So this is going into keeping that information fresh. The CDD rule requires that financial institutions update the CDD information, the beneficial ownership information, upon a trigger event, meaning an event that changes the customer's risk profile, including the beneficial ownership. And then for the BOI reporting rule, it's within 30 calendar days that the entity knows. And here we have, again, the should have or should have known of any changes. So there are differences. We see here, it's clear that FinCEN, why the third rulemaking will have FinCEN rescind the CDD rule and reissue it to align. The question that some of us were talking about before the panel was really, does that new CDD rule actually simplify, right? The whole point of the AMLA, or part of the point of the AMLA, was to simplify BSA within the United States. We'll see if that actually happens.
Samantha, building on that, just to show, I think it's useful to go into some of the language to show why we say this is so broad as to basically cover maybe almost everybody. The idea of a beneficial owner, and this is the language in the statute and in the regs. It's an individual who, directly or indirectly, through any contract, arrangement, understanding, relationship, or otherwise, does any of these things. And when you define substantial control, after talking about things like you have substantial influence over important decisions, it then has a basket which says, in effect, if you have any other form of substantial control, you're a substantial controller. So it's a circular definition. The same thing applies in ownership. Basically, it's not a definition that is limited, and it's something that is going to require in any complex structure a lot of thinking. There is an attempt in ownership to try and give you a way of figuring out how to solve the equation for a complex ownership structure. And we don't have time for that. But when you have puts, calls, promotes, preferred returns, preferred stock, there is an attempt to say how you do it, but I don't know that it does it, and we don't have time to talk about it.
Yeah, I mean, in some respects, it's not unlike where we are with determining whether an unusual matter is, reaches the critical mass of being filed for a SAR, right? The government would not give us anything too prescriptive, so the way it becomes an analysis of facts and circumstances, and then depending on your skills in saying that I believe that it is or isn't, is how it gets done. And the same might be true here, right? Depending on a controlling person or other things, it seems like they were reluctant to give us too many bright lines, but maybe that was for the best, although it certainly makes it more complicated. Sam, do you want to do the next slide, and then we can skip into case studies?
Sure, and I won't spend a lot of time. I know we're running short on time. So FinCEN's approach, small companies, they believe are not going to be overly burdened. Interesting that the lawsuit was filed on Tuesday, stating exactly the opposite. So we'll see how that plays out, if anything changes. I can't, again, personally see anything changing on that front, but maybe there'll be more clarity. And this goes into, the second bullet goes into the complex structures, right? If they have elected to be complex, right, there's no sympathy. I think that's a little bit too simplistic to think that there is an election to be complex rather than, a real compelling reason behind the complexity. I think we can move on, Deb, to the case studies.
Yes. So perfect. So I'm just going to touch on some of these at a high level, only I'm being cognizant of the amount of time we've got left. But part of the reason this law has come into existence is because of some of the issues and some beneficial ownership registries and shell corporations have been used inappropriately to further further money laundering or corruption. So, there's certainly been instances in terms of multi-million-dollar transactions where you've got the underlying entity is basically hiding behind various layers of various shell corporations. You've got a number of issues that have arisen in terms of foreign countries as well. As I mentioned earlier, FATF actually had indicated that the U.S. AML standards were not quite where they needed to be because we weren't requiring this information of beneficial ownership as other companies, as other countries, or at least some have done. Why don't we go on to the next slide? Yeah, and obviously, there's been arms dealers that have convicted when they found out who was underlying it. Clearly, that a big portion of this is the law enforcement agencies will definitely be looking at this information to determine, and connect the dots, as it were, in terms of who's got what and what shell companies there are. And you've got to remember, for FinCEN, that's also going to get overlaid on top of all the suspicious activity reports, which, by the way, I apologize for those of you who don't know, a SAR is a suspicious activity report that has to be filed with FinCEN, which are incredibly confidential. As a matter of fact, if you tell somebody on whom you filed it, it's a crime itself. It always begs the question whether you needed to then file on yourself, but we'll put that aside. But at any rate, there's certainly been a number of schemes that have come out of, beneficial owners being hidden in layers of shell corporations and the like. And that really is the biggest reason behind all of this new law. Why don't we go on to the next slide?
And Deb, we have a question in the chat about, how financial institutions will deal with if the information in the registry differs from the information that they've collected as part of their KYC. I think that's one of the challenges here, but maybe you can touch on that.
Sure. And actually, I think, as we discussed, actually the CDD rules that are currently in effect are different than this new CTA rule. So I actually think there is going to be variance between the two. As I suggested, my guess is for a number of banks, assuming that they're allowed to do so, will probably continue collecting the information that they collect today because they want it for purposes of their KYC and anti-fraud purposes. And not all of them are going to want to go compare it over to the FinCEN registry. I believe, again, I think currently the financial institution would have to get consent of their customer to do that, which would be kind of an interesting question to ask, unless maybe you baked it in front. But I just don't know that you want to go to your customer and go, hey, we want to see whether or not your beneficial ownership information, lines up in terms of the information you've given us versus what FinCEN has. I just don't think a lot of customers are going to be very open to that, but maybe I'm wrong. But I do think it's going to be something everybody's going to have to work their way through. And I see we've got a question, which I'll just answer quickly, that says the law says that violations occur when one willfully, voluntarily, and intentionally lies, defrauds, or omits reporting information. And what happens when it's accidental failure? Well, the reality in terms of an accidental failure is you've got a certain period of time to fix it and get it correct. I will say, generally speaking, in terms of law enforcement and FinCEN to some extent, if you've filed a report that's incorrect in information, there's not really a big saving grace provision that protects you. It's there's an expectation that you've got it right. And in this case, you're going to have to track it to make sure that you are within 30 days if your information changed. And if you don't bother to do that, or you haven't bothered to stay on top of who are your beneficial owners or all the changes in your company, that is a violation of federal law. And it will be a violation of the Bank Secrecy Act. So I don't think there's going to be a lot of latitude on that front, just because I think, again, they want this information. They expect it to be filed appropriately.
Agreed.
Next slide.
Well, I think we've covered most of this slide because we've given you the timeline. And so I think we can move on.
Okay.
Actually, Andrew, the one thing I don't know that we've talked about quickly is the timing for reporting. So for companies that have, what happens for companies that are not in existence before 1/1/24 and 1/1/25? Andrew, you want to just walk the audience through that?
It's on 1/1/24, you've got 30 days. They've got 1 year. And if you come into existence from and after January 1/24, you've got 30 days after your formation in effect becomes discoverable from whatever the registry is when you file. So it's a little longer than 30 days, but it's plus or minus that.
Okay,
Next
that
slide.
is great.
Sorry.
By the way, if I were, I think there are probably a lot of people who may have already figured out that what you're going to do is create a lot of companies on December 1st, 2023, and buy another year. But we'll see if they do that.
I'm certain. Hey, so I think we have less than a minute left. We might have time for one really quick question. So anybody have one? We good?
Can I give one practice pointer?
Yeah, sure.
I think that every lawyer should be going back to his or her clients and saying, if you've got any kind of a joint venture or a complex capital structure, get everybody to agree to comply with this and get everybody on board now. And any finance lawyer who is doing loan documents has better get the consent and disclosure in those documents, or you're going to look really bad to your lending clients.
And in terms of the bubbles here, I think we've answered a lot of the questions, but there's one question about, is the FinCEN identifier another number we need to keep track of? I think the answer is, if you have one, yes, you do.
Other concerns about, we've talked quite a bit about substantial control being a concern here. The definition of ownership and how that plays out, right? Puts, calls, straddles, things like that are critical. I know we're coming up on time. Sal, did you want to take us out here?
Yeah, I think so. We haven't talked about the takeaways all, have we?
Not yet. Please do.
Not yet. Yeah, let's
Some of that we've hit.
Yeah, should we run through that quickly? If anything
Sure.
that we missed? Yeah.
Sure. I'm happy to start, and others can add in as they deem appropriate.
Great.
Obviously, there's a heck of a FinCEN registration that's being set up with 32 million companies that will be expected to file in the first year and another couple million every year thereafter. That's not even including updates and changes as appropriate. FinCEN does indicate that they recognize they're going to have to do a lot of outreach to state and tribes and other governmental agencies in connection with entity formation. That said, whether they would, I personally don't know that they're going to significantly change the timeframes for when this becomes effective, even if all those government relations aren't and issues aren't worked out in the next year, but perhaps one can hope. We've mentioned that under certain circumstances, the registry data can be made available to law enforcement and possibly to government agencies under certain circumstances. Clearly, that's got to be done in accordance with applicable law, and obviously law enforcement will need to attend to that appropriately. I think.
Yeah, and I think the one that I would throw in would be that, maintaining the beneficial ownership information is going to require tracking, various different events, whether it's an expiring date or an anniversary date or the change of a control person, change of a board, and or an officer or general counsel, as Andrew was saying earlier. And so the way we maintain this has to be sensitive to those triggering events and identify them so that we may make adjustments and be up to date too, correct?
Yes, it is. And actually, Sal, that I want to just note, we've mentioned, we've got to track whether somebody's a minor who, when they are no longer a minor, have reporting obligations. But I note on the other side of that, if you've got somebody who's a beneficial owner or becomes a beneficial owner upon somebody's death, you're going to have to track that too. Mm-hmm. Which, so you're actually going to have to, the companies are going to have to track really sort of both sides of their business and their individuals, sort of on an ongoing basis in order to comply with this.
Yeah, and having a pretty wide familiarity with those kind of systems that track customer data or attributes or even internal governance processes like officers and things, those are not all when they're there, they're not all connected or easy to link together, right? So I think that is going to be potentially getting all that and having it land in one place is going to be a challenge.
Yeah, it's not clear to me that a rule of reason is going to be adopted by FinCEN, but you should at least adopt your own rule of reason, which is to be able to document that you've tried really hard, because you're not going to succeed.
Got it. And with that, I think we are going to wrap, and I would like to say to everyone, thank you for your time. Thank you for your great attention to this. Thank you for your astute questions, and to our panelists, thank you for your brilliance on this subject matter and your ability to come together and present such a comprehensive summary of this matter. Thank you. Thank you all.
Thank you.
Thank you.
Thanks, everybody.